Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. What's up, guys? Welcome to another Market Radar podcast. We're recording this one on Monday, September 5th. Gamma just got back from vacation, so had to push it back a little bit. Apologies for that. Let's get started with the year-to-date performances. Market was down this past week. Year-to-date, S&P is now down 17.42%. NASDAQ down 25.81%. Russell down 19.04%. And the Dow is down 13.64%. All four of these indexes continue to be bearish trend. We've got a stagflation odds remaining the same as last week at 35.8%. Deflation odds remain the same again as well. And inflation odds didn't really move either. So it was a pretty insignificant week in terms of regimes. But we did see a pullback in the market, as we've been saying was going to happen. So let's look at the calendar for next week. Let's see what we're expecting here. We've got ISM Services Index on Tuesday. That's the only market moving event happening. Wednesday, we've got International Trade in Goods and Services. We've got a bunch of Fed speakers. I'm not going to name them all. And then we've got the Beige Book. Thursday, we've got jobless claims. We've got the big man Powell speaking. EIA natural gas report. EIA petroleum status report, and we've got Fed Evans speaking, and then we've got the Fed balance sheet. Friday, we've got two more Fed speakers. So those are the market moving events for next week.
Yeah, and before we go into the rest of the nitty gritty stuff, let's go over the important recap of last week and what happened. So we had the S&P Case-Shiller Home Price Index as of June come in at 318.63 with a year-over-year change of 18.65%. The forecast was for 19.5%, and the prior figure was 20.5%. So again, more data signaling the housing market is slowly decaying, which again is to be expected given the higher interest rates. We had consumer board confidence as of August come in beating estimates at 103.2. The forecast was for 97.9, and the prior figure was for 95.3. So a big beat here, and excuse me, a big beat here as this was higher than the forecast and the prior figure. I apologize. I am jet lagged at the ass right now, but let's go to JOLTS. And I do not have a screenshot for consumer board. So if you guys are wondering where that is, I don't have one. So let's go over JOLTS. JOLTS came in beating estimates at 11.239 million. The forecast was for 10.475 million, and the prior figure was for 11.04 million. Then we had ADP non-farm employment change for August come in missing expectations at 132,000. The forecast was for 300,000, and the prior figure was for 268,000. So you can see here, this is ever so slowly treading towards zero. Chicago PMI, we saw this come in slightly above estimates at 52.2. The forecast was for 52, and the prior figure was 52.1. This came in above both the forecast and the prior figure. We're still seeing a steady downtrend here towards the 50 mark. And remember, under 50 is considered to be contraction territory. We saw crude oil inventories come in well under estimates, again at negative 3.326 million. The forecast was for negative 1.483 million, and the prior figure was negative 3.2 282 million. So this was the third consecutive week of negative prints here, something to watch as the oil um, inventories remain tight, supply is constrained, which should help push prices higher. We had initial jobless claims come in under estimates at 232,000. The forecast was for 248,000, and the prior figure was 237,000. So this is still holding a negative month over month change, and this came in under both the forecast and the prior figure, signifying that the labor market still remains not or undistressed or non-distressed. Um, we had manufacturing PMI as of August come in above estimates at 51.5. The forecast was for 51.3, and the prior figure was 51.3. So this came in above both the forecast and the prior figure and is holding above the 50 mark. ISM manufacturing employment as of August came in above estimates at 54.2. Forecast was for 49, and the prior figure was 49.9. So this was a nice beat to the upside with a print back in the 50 area. Remember, the prior print was under 50, so we're now back in the 50 area there. Then we had ISM manufacturing PMI as of August come in above estimates at 52.8. The forecast was for 52, and the prior figure was 52.8. So this was unchanged from the prior figure. And if you guys are wondering, the next screenshot we have here is of non-farm payrolls. So these small ones in between, they're not small ones. TradingView does not have some of this data, so I do not have screenshots for it. I just speak about it. For the ones that I have data for, I show you guys. So let's go to the average hourly earnings year over year as of August. Came in below estimates at 52.2%. Excuse me, 5.2%. The forecast was for 5.3%, and the prior figure was 5.2%. So below estimates, but unchanged from the prior figure there. Now, here we go with uh, non farm payrolls as of August. They came in slightly above estimates at 315,000. The forecast was for 300,000, and the prior figure was 526,000. So, um, pretty much a decent decline from the prior figure, but we're still holding above the June number. So we're not seeing such a deterioration here yet, but it's something that we are going to watch. Then we had private non-farm payrolls as of August come in slightly above estimates at 308,000. The forecast was for 300,000, and the prior figure was 477,000. So unlike non-farm payrolls, private payrolls are seeing a decline against their prior numbers. We're actually below the May level, while the other one here, the regular non-farm payrolls were holding the June number, so we're seeing some deterioration here. We're also seeing some bigger month over month, year over year declines, where on we're not seeing them as large here on the regular non-farm payrolls. Um, I'm sorry, on a month over month basis. Oh no, actually, nope. I'll correct myself. They're pretty much the same on a month over month, year over year basis. We're just not seeing the broad based sequential decline from prior figures here on the regular non farm payrolls as we are on the private payrolls. And let's go to the unemployment rate. Again, slightly higher, barely higher than earlier this year. And if excluding the 2019 era, this is some of the lowest unemployment rates we've seen since like the early or late 70s or late 60s, early 70s. So this is comically low when we talk about recession and tight labor markets. Those don't really sync together because whenever we do see some type of economical upset, this goes way up, way quick. We have yet to really see this explode. To say that this is the start of the start of an upward trend is also comical because we are really no higher than we were at the beginning of the year. So this
We
is
basically
kind of
need to see this go up. We need the labor market to get crushed if we want a Fed pivot. And Fed pivot
yeah.
like is they're cutting rates, not just holding rates. They have to cut. We need to see this get crushed essentially.
Yeah, I mean, Powell's crushing one with the boys right now. You think he's gonna give a shit about a pivot?
Definitely
Like,
not. This
yeah,
like pivot is like nowhere near. Don't even have the idea of a pivot in your mind. Don't base any financial decisions on a pivot right now
yeah.
because that's the dumbest bet you can make.
You're about to pivot your trades into the fucking shitter if you do that. I'm
Yeah.
telling you right now. Um, yeah. So let's move on to unemployment from the unemployment numbers. We'll go over this in a little bit, and let's just go over factory orders. We saw the first negative month over month print for the year so far. So that's really interesting. We're starting to see some weight on um let's sum this up real quick and we'll go over it. So it came in well under estimates, obviously at -1%. The forecast was for plus 20 basis points. So the forecasts and the big economic guys on the street had this staying positive, with the prior figure being 1.8%, and obviously shit the bed, came in straight negative. And again, this is showing that there is some weakness starting to appear within the internal components of the economy, starting with factory orders. Now, how far this goes, I can't. I'm not going to say like, oh, this is going to keep shit in the bed or it's going to bounce. It's not what the whole point of these recaps are. This whole point of these recaps are to basically put in front of you data points, and um, you can see based on our verbiage that of how often things are beating or missing estimates and where they are on the chart. That's what we're doing here. So obviously this is missing estimates to the downside in negative territory. This is a bearish point. This is something that would fit the risk off regime we're currently in. So something like this is what you pay attention to when the system says risk off, as with all the other missing or bearish data points that inhibit the market to go lower, and the Fed to continue its tightening process. One being the employment report, and I know that the Phillips curve is archaic. I know that I it's textbook shit. It's not something that's like, oh yeah, you're gonna it doesn't work in real life. I'm well aware, but the reason why I bring this up to you guys and we talk about it is because the Federal Reserve believes it's true. Use this and they do this, and or they build policy around this. It's important that we understand what's going on. The Federal Reserve is going to watch employment or unemployment, and they will really not get too worried until unemployment does take off, even though that unemployment taking off is certainly a lagging indicator, right? That is a data point that is coming out a month a month in delay, meaning shit can hit the fan for 30 plus days before we see any type of print come out. And if that print does come out and it's, you know, like what we're seeing right now, it can be a pent up you can have layoffs kind of wind up, right? You can have a major layoff wave start at the last half of the month and end in the first half of the next month, and that data doesn't really get really pretty much presented into data points for almost 2 months. You know what I mean? So that's something that we have to pay attention to in regards to like the concept that the labor market is tight until it's not, and when it breaks hard. So we're paying attention to that, and the Fed is too. But the problem is the Fed is going to look. They're going to see unemployment break, and they're going to have their Fed meeting, and they're going to say, "Okay, it's time to cut rates,"
Yeah.
whenever
And
that is.
well,
Right.
it might not even be unemployment that breaks first, but something is going to break.
Right.
Like
I agree with that.
with this
It
stagflation
may
that
not
we're
be
in,
unemployment. Yeah, it may not be
yeah,
unemployment.
it may not be, but there is going to be a Lehman moment. You know, that was kind of the spark that set everything off in 2008. I'm not saying we're going to get a 2008 type event. This might not even be the big one. I know everyone likes to be all doom and gloom and say that the world is ending, but this might not even be it. But we do know that stagflation is not a comfortable position for the market to be in. And when stagflation ends, there will be a whipsaw. Something is going to break, and there will be a whipsaw, and there's going to be immense opportunities to profit. And
Yeah,
that's what we're
that's a
waiting
good
for.
that's a good way to put it. So basically think of the regimes, these regimes here like a rubber band, right? This is the rubber band. It stretches this way and stretches this way, and then it all snaps back towards the mean, right? So if you get inflation, you get deflation, you're coming back down, you end up you go from low here to high here, and it's kind of like a wave, pretty much a rubber band, right? So you get pulled down, pushed up. We're in such a deep, or I should say, a very pulled out stagflation that when something breaks, like, listen, could we get risk on? Our system will let us know. Either way, if we get a risk on pivot or straight deflation, that pivot that we get whenever we get it will likely be very confirmational and very directional. And there will be money to be made, but there's also going to be a lot of, I should say, destruction into that, meaning front running that is not the way. Front running that will get you smoked because this is the regime where cash is king, and a lot of people cannot sit on cash for too long. Either they have investors to satisfy, they want to charge management fees, and they want to basically collect a carry, carry for those that don't know is performance fee. For them to do that, well, they need to have investments, and cash is just not an investment. So they will always look for that angle. Oh, there's always our boy Jim Cramer will love to say, there's always a bull market somewhere, right? Like that's what
Yeah.
these people are looking for. If it's we're gonna catch we're gonna fade CPI by longing bonds. Yeah, that's again, where that story went this year. Or gold, it's the same shit over and over again, and there's no real way to go. But when there is a way, that's when we want to take advantage of it, because that's when the money, it's kind of like everyone's taken their shot and failed, and now everyone's just like despair. That's really when the best system pivots come, is when you're in that despair phase where people are just like, fuck, I throw the towel in, and things start moving, and it's like, oh man, like I bought it all the way up to here, I have no more money to buy it, now it reps. It's that type of mentality or that type of action is when you want to put your full foot into the game, because that's where the big money's made. While everyone's like working to get back to break even, you're putting big alpha points on the table, and that's
Yeah,
what we're trying to
and
do.
that's a good point towards the elastic move with all this cash sitting on the sidelines. A lot of people are holding U.S. dollars when there is that bull market in whatever play. Bonds, whether it be bonds, whether it be a risk on regime, all that money's going to go towards that, and the rubber band move, is going to be immense.
Right, and I think
It
it's
might
also,
even be like the biggest we'll see like in a while.
yeah, I
COVID was
think,
a big one. It might even be, I don't know. I don't know if it'll be bigger than COVID, but
well, just remember this, right? So a lot of, I know this is going to piss some people off that listen to this, but look, we've been telling you guys that the bonds will be a play at some point, but there is a possibility. And I think I've been very clear that the system will dictate where we move our money, but there is a possibility that bonds are not the play. And I'm going to tell you why. From a simple, this is not detailed. You don't need a fucking PhD to understand this shit. But long story short, if inflation stays higher for longer and it takes longer to handle that inflation, bonds can chop for a lot longer than you think, and we can have a higher normal interest rate. Meaning, a lot of people are chasing. Okay, so let's look at the 10-year real quick before we go into our ES review. So the 10 year is trading at 321 basis points as of right now. A lot of people are looking at this like, oh, I'm going to fade this all the way back down to the ones. You got David Hunter saying some fucking absolute nonsense, like we're going to go what some
yeah, just some
yeah,
dumb shit.
just some dumb shit, which we've went over his fucking this whole thing with David Hunter. I honestly, I think the podcast we did that was like over here somewhere. I don't fucking remember. I'm too jet lagged to remember where the fuck we did that, but we did that somewhere over here, and we were like, yeah, like this shit's not gonna end, and obviously it hasn't ended yet. I'm not tooting my horn or being arrogant. I'm just saying that you have to look at it from a perspective that, and let me put it to you this way: when you're buying long-term bonds, and we'll even go out to the 30-year for it to be more, TLT's 20-year plus. So let's look at this. You're basically saying 30-year, okay, you really want this to fade down under 1.5 to 1.4%. Like that's where big returns are going to be made, right? You're not going to buy this for
Yeah.
a move down to like 3%
Yeah, like
or
the big
2.8.
conviction bond trade is when
Yeah.
bonds
Yeah.
really go, like yields
But
really go down to their lows.
But for you to have that to happen, you have to have inflation well under control and actually falling apart. And what I'm trying to say is if inflation is, let's just say, controllable but slowly fading, meaning let's just say inflation now we have inflation at, go over this. We have inflation at 8.5%, right? Let's just say we get inflation under control here and we don't get some type of crazy rally into the winter with any shortages of supply, which we'll go over that whole issue in a few minutes. But long story short, let's just say this is under control, right? And this starts fading lower. And this goes, and this goes, and this goes. Well, we know that over time, the 30-year likes to be above the rate of inflation. We've spoken about this. You can watch our prior podcasts. There's reason behind it because long-term investors want to have a positive assumed real yield over time. For that to happen, most of the time, the 30-year is going to stay over the rate of inflation because the rate of inflation, as it stays and sticks, is going to bleed more into real yields, right? So
Hmm.
if we go to T30, right, the break-even inflation rate is now 2.29%. It was hovering for so many years between 2 and 1.5. We're well above that bound right now. And what I'm trying to say is, we're on a daily here. Yeah. Oh, this is not. Does this trade once? Is this like a once a month thing? Yeah, it is. Sorry, guys. This is like a once a month.
Yeah, but
Yeah.
like, so you're trying to say that it
Here we go. Here we
it
go.
could take years, right,
Yeah, what I'm
before
trying
we
to
get
say
down
is
to normal.
this is the real yield. This is what I'm trying to show you. This is the real yield on a treasury right now, 1%, right? So as inflation sticks higher, this will grind higher because the term. So just remember that this is pricing at a 1% real yield right now, right? For 30 years. And notice that when this went negative, it barely went negative, right? When everything else shit the bed, this went negative, what, 30, 40 basis points and kind of bottomed and ripped back up. Again, who's going to lock in a negative real yield for 30 freaking years? I'm not. I know, and no one is. It's retarded. A 30-year, listen, let's just say we all get to live to a ripe age of 90. A 30-year life is negative real yields. That's I mean, you got brain damage if you're doing that shit,
Hmm.
right? Like it's no bullshit. So if that's the case, why like this what I'm trying to say is if inflation being sticky is the case, then the real yields on the 30s are going to rise because over longer and long it's going to start. Obviously, if inflation is sticky, you're going to start to see it in the shorter term yields because that's what's being affected. It's kind of like the federal funds rate. Um, the longer that inflation stays elevated, the more it bleeds into duration, right? So every month it stays in there is more and more pressure on the short term, and then every year it stays there is more and more pressure on the longer term, right? What I'm trying to say is the higher and stickier inflation is, even if it's fading, is going to put pressure on real yields to the upside over the curve, especially with the Fed also adding to the flames or adding fuel to the flames with hiking rates. We know that the Fed hiking interest rates pushes real yields higher because they're both constrictive mechanisms of the economy. They're both signals of constricting or tightening economic environments. Right, higher federal funds rates and higher real yields they move
Yeah.
higher because
Well,
the Fed
so this is a good
controls
segue into
marketability.
ZN. Let's talk about ZN.
Right. So let's talk about that.
So that's
Z
basically our bear case for ZN, as you've just heard over the last 10 minutes.
Yeah. Yeah.
ZN probably will make new lows. very likely. Um,
Right.
and at the very least, chop in this area for the foreseeable future until we get some sort of change happening.
Right. And that's important to simplify because um as this whole um discussion about interest rates and inflation started, remember the bonds are not the play until they are the play, and that signal with a bullish trend, meaning that if you're trying to front run this right now and we get a risk on pivot, you're going to it's going to hurt because you're going to have to book the loss to move the money, right? So if we get the risk on pivot and this stays in bearish trend and you're trying to like, oh, we're gonna fade this. I'm gonna try and fade this into deflation, which that only works fading bonds from stagflation to deflation when bonds are bullish trend within stagflation. That's a what we would call a directional regime. There's a place to go. There is no place to go right now. So by pivoting right now, and let's just say we don't get that bullish trend, and we get the bullish trend in risk assets, well, you have to move the money now. You have to be concentrated in risk assets because that's where the regimes go. The system is telling you the regimes are going, and you're basically taking unnecessary losses
You're
here.
taking a
I
double
might
whammy. You're taking a loss
yeah,
on bonds, and then you're also missing out on any moves that happen during that time in risk on in TQQQ or any other risk on
right,
play that
right,
you want to take part of.
right. And I think that's where we can leave that off, and we could segue into real yields. Which what a recovery. So let's mention
Yeah,
that real
so
yields
that
go.
alone is bad for ZN.
Yeah, that alone is bad for Zen. Real yields going down is deflationary, right? The deflationary signal of real yields breaking lower, which we saw them bounce, go pretty much from where they are now down to zero, hold and bounce. And this had a lot to do with nominals staying nominals and nominals taking a dip while break evens uh, didn't move. So nominals took a dip and they compressed real yields, and obviously nominals have come off their lows. And this is primarily due to the fact that the market is playing games on what's going on. We know that the Federal Reserve is not going to pivot unless inflation is under control. And we really start to see this excel to the upside. Not last week, but the after the Jackson Hole meeting, where things became quite clear that Powell was not going to pussy out and go full tilt to the Dove camp. He's gonna hold hawk until there's no longer a need to be a hawk, and the market it realized that in the last week and a half with ES pretty much falling. At one point, I think it was like 6 sessions in a row or something like that, right? Down like
Yeah,
6 days in a
yeah,
row.
it was
Yeah, something like that.
pretty rough couple of weeks.
Yeah, and that's just the market telling you like, ha, psych, we got you. That's all it is.
Yeah,
It's like, yeah,
basically just trapped all the pivot
yeah.
kings, the bulls.
Yeah. Who loaded up on risk assets? I mean, I listen. We've all seen them, and I know I said some things about David Hunter and doing some stupid shit earlier. Again, we made a very respectful podcast about our views on and what we thought about him. We went over the topics in simple detail, and I'm just telling you that um, there are people that are falling for this nonsense, um, and I don't know why because there's actually there.
Well,
It,
people are bored. People need places to put their money.
I know
No one wants
that's
to hold
pretty much it.
cash.
Yeah, I know that's
They
really
want
it.
to pile into bonds. They want to pile into
I know.
risk on assets. Like no one wants to just sit and chill. And that's why this regime is so dangerous because that's the best play is just sitting and waiting it out, which no one wants to do.
Yeah, and I mean all these guys, they should just go to like these guys like David Hunter with these narratives, and there's a bunch of other ones. I mean, got the Bond guys all over Twitter.
Yeah, everyone wants to
They,
call the bottoms.
yeah, they should start writing books because they're really good at telling stories. They
Yeah.
really are.
They're not good at making money though.
No, no, they're not. Long term, I mean, you guys that are with us, you stick with us, you'll see. Um, as a New Yorker would say, there ain't no cap in this rap. All right, I ain't bullshitting you. This is not something that I can simply put on your lap and say, "Look," because if I did, I would be doing you a disservice because the human the way the human mind thinks is very primal in the fact of like if something works, they want to use as much as they can right now to make as much money as they can tomorrow when in reality, if you do that, you will get smoked. And it's very hard to understand that if I show you something with phenomenal performance, most pretty much everyone will pay no attention to the respectable drawdowns that come with that and only look at the upside. And that 30% drawdown or whatever it is, over 10 or 15 years doesn't mean shit. But if that 30% drawdown were to happen to you right now and you leverage yourself up 3x from whatever means, again, out of my control, we're not financial advisors, I can't tell you what to do with your money. But if you do that and you lose money, I would just morally feel like I did the wrong thing, even though I know that it's not my problem. You listen, you fucked up, you blew your load. Again, your shit, not mine. But I would still feel as if I led you guys down a wrong path. That's why I'm doing everything step by step from start to finish with you guys. And again, no bullshit. We're going to show you how to take it from A all the way to Z. It's kind of fucked though because we're managing one of the hardest macro regimes that we've seen in at least the last 2 decades.
Yeah, pretty shitty
Um,
timing on our part.
yeah, yeah, pretty shitty timing on our part, but it's also beautiful in the same time because you guys get to see that like there's no perfect system, right? Um, the system I made that we talk about and that we follow, um, and that I should say not that we made, right? That we refined, we made, and we built. Um, that system is not perfect. It's very
It's
close.
pretty damn close.
It's pretty damn close.
I'm so
But
excited to just be able to show it off, show off
I
the
know,
performance.
but it's not perfect to the point where, like I just said, I know the system in and out. We know. I'm not stop using the word I. We know the system in and out, right? Because
Yeah, we
we
both we
created it,
worked day and night on
right?
it.
Now I, but the reason I say that is I know the downsides. If there's a 30% drawdown that can happen here, or maybe a 15% drawdown that can happen here, there's times that to use leverage, right? Maybe that 30% drawdowns with that 30% drawdown is with running like a 2.5 to 3 times leverage ratio on your account, but that happening with the wrong person at the helm, not understanding how that works, maybe leveraging more than they understand is not something that I just want to build a brand upon. I don't want to build a brand that's around surrounded by not arrogant. Arrogance is the
Pretty much
wrong
just
word.
mindless gambling at that point and
Mine,
following.
yeah,
Well,
yeah,
we want everyone that listens to us to understand why we do what we do. And that's really important because when you put a lot of money on the line, which we do, you can't get faked out. You get faked out, you get screwed over. And you have to understand the ins and outs of exactly why you're doing what you're doing. And so blindly following, you see your account draw down a little bit, you're going to get scared. You're going to get out. You're going to start asking us questions, pissing us off. Oh, what about this? What about that?
right.
Because you don't understand it. And that's why we do what we do today to get everyone up to speed. And when the time comes, we ride the lightning.
Yeah. And drawdowns, listen, drawdowns suck. They really do. But in the grand scheme of things, the system is designed with one thing. With one thing as a primary function, and that's to compound returns. That's what it's for. That's why we use leverage. If we wanted to build an all-weather model or something that sat there and hedged all risks at all times, we would have designed something that was more generic and didn't require such attention and focus, right? But instead, we want something that, listen, when the iron is hot, we want to be striking. When the iron's cold, we don't mind sitting out because those strikes when the iron's hot, boom, 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 those compounds are very powerful. And as long as you stick around long enough to find those streaks of compounding, quick you'll soon realize that um why I don't drop all the eggs out of the basket at once and show you guys all what this has done rather than do it with you in person, because it builds up your confidence psychologically it builds your character and trading confidence up in a different way where you don't have faith in me because I don't want you to have faith in me. I'm not your god, I'm not your teacher, I'm not your master, I'm not your fucking guru. um I want you to be confident within yourself. So when something happens within the system and you see the system, I want you to have confidence within the system, right? I want you to, let me put it this way. I want you to have confidence within the system to have confidence within yourself. So you see the system and you know that what you've done has been working. So you have the confidence within yourself to follow the system and make your own decisions. That's what we're trying to do here.
Yeah. And
That's really it.
I think that's a good place to end it off here.
Yeah. All right. Um,
Thanks for listening.
Yeah. Thank you guys for listening. I apologize for the rants today, but it's currently equivalent of 5:30 in the morning for me. So I am
Yeah, you've
I'm
had a pretty
shot.
long day.
Yeah, I'm shot. I'm stretched. So I'm gonna go to lay down, and I will see you guys in the pit in the morning. Thank you guys for listening. We will go over a few nuggets that we did not get to cover in this week's podcast in the pit tomorrow via messaging. So if you guys want to catch up on a few little tidbits on what I was doing on vacation, what I think about some things I've learned about from being on vacation, I will release them in the pit tomorrow. We'll talk about them there. Please come and check it out. And everyone, have a great start to your week. I hope everyone had a great holiday weekend, and we'll see you guys next week. Thank you so much.